Hello and very warm welcome to Victory IAS YouTube channel. As you know, we are discussing 2 years rapid revision current affair. So let's discuss few topics from economy related to banking issues, right? RBI proposes higher 50% dividend payout ratio for healthy banks. So here two topics we need to understand. What is healthy bank, right? As you know that financial health of the banks can be measured through various indices, various parameters. One among them is capital to adequacy ratio, CAR, capital adequacy ratio. Also, we can talk about Basel norms here, right? Basel norms can also be discussed, right? Basel norms, for example, to how much CAR to be maintained, capital adequacy to be capital adequacy ratio to be maintained, and what is the net this non-performing asset. Non-performing asset, as we have already discussed, when we talk about loans extended by the bank, known as asset. Loans extended by the bank known as asset, and when bank is not receiving principal amount and as well as interest amount on that, so it becomes non-performing asset after 90 days. So it is known as non-performing asset. The amount that bank provision for this non-performing asset, that amount if we subtract, then it becomes net NPA. So net NPA and gross NPA. What is net NPA? Net from gross NPA, if we subtract that particular amount which has been already provisioned by the bank, then it is known as what? Net NPA. So this is also one of the indicator. CAR, capital adequacy ratio, is also one indicator through which we analyze what is the financial health of the bank. So payout of dividend, right? That means 50% dividend can be paid to the shareholders if bank is having better financial health. Earlier it was 40%, so now it has increased to 50%. The RBI has proposed this. The RBI has released draft norms allowing banks with strong financial metrics to increase dividend payouts to shareholders up to 50% from the earlier 40% ceiling, right? So the key highlights here is bank must have net non-performing asset. Net non-performing asset, that means from gross NPA they have subtracted the amount that has already been provisioned by the bank. Ratio below 6% for past 3 years. So for past 3 years, and net NPA ratio should be less than 6%. Minimum required capital adequacy levels, that means they are talking about capital adequacy ratio should also be met 50. This is what RBI suggests to the government for the banks. For example, maintaining 11%, for example, maintaining 11% capital adequacy ratio. 50% payout ratio applicable for zero net NPA banks, right? For zero net NPA banks also. Ceiling, and if they are having some net NPA, then for the last consecutive 3 years it should be less than 6%. Ceiling reduces on higher bad loans, just 15% over 4% NPA. One time gain items excluded from dividend calculation, erased repartition of foreign banks branches meeting criteria. Now why it matters, why this particular news matters to us? So let's understand. The move incentivizes lenders, that is banks, to further boost balance sheet equality by linking returns to shareholder with asset performance. So they are linking with asset performance. That means whatever profit etc they have accumulated, they are sharing it with the shareholders. It may also allow the government as majority owner in public banks to gain higher dividend inflow, right? Since public sector banks are owned by the government, so if government banks are sharing 50% dividend, then what will happen? This 50% dividend can be given to the government, and government can utilize this fund for various expenditures as welfare expenditures and maybe expenditure on infrastructure and all. Healthy private banks too can now offer better returns potentially also, as most meet the tightening net NPA norms of under 6% already, right? This is this private banks are already meeting this requirement. No ad hoc relaxation. The RBI emphasized it won't entertain discretionary dispensation for dividends, mandatory or mandating strict eligibility compliance. This ensure only fundamentally strong banks pay higher returns based on real performance, because banks' financial health is needed. Better financial health is needed for banks, because we understand the banks don't own the money that the depositors are depositing there, right? Merely banks are protecting, or banks are handling this money, and whatever they are giving to the borrowers, this money is depositors money and not the bankers own money. So that is why financial health of the bank should be better, so that people can have more confidence in the banking system, right? Broader context here is Indian banking had seen poor dividends earlier with high stressed assets. When non-performing assets are high, when banks needs to provision more amount, then banks are not able to share dividends with the shareholders, right? So that is why we have seen in past that these poor dividends, that means profit sharing was not much. The tide has turned since lender repaired balance sheets, this allowing the revised graded linkage. Banks have also raised substantial capital in recent years to meet credit demand in a growing economy. This capital is also known as tier 1 capital and tier 2 capital. Tier 1 capital, which is more liquid, tier 2 capital, which is less liquid, and tier 1 tier 2 capital combined together with the weighted risk that is there with the loan is known as what? Capital adequacy ratio. This is what you need to remember. The new dividend guidelines balance shareholders returns with long term resilience. Now let's talk about Indian stock market, right? India has surpassed Hong Kong to become the fourth largest equity market globally, with the combined value of shares listed on Indian exchange reaching 4.33 trillion US dollar, combined to Hong Kong 4.29 trillion dollar. So stock market, now people have also got little more financial literacy, and we can see here that the kind of volume is increased in this trading markets. The top three stock markets are currently the US, China and Japan, and fourth now India. India has become the fourth one. Fifth one is Hong Kong now. This achievement marks India's ascent in the global financial landscape following the crossing of 4 trillion mark. India's stock market growth has been attributed to factors such as strong GDP, political stability. Since last three terms, we are witnessing same government, more or less same government, foreign portfolio investment, and FPI becoming alternative to China for global investors and companies. For example, this COVID, etc., have shown some trust deficit in China. So India is also emerging as China plus one. That means one alternative to China. In contrast, Hong Kong has faced challenges including COVID-19 restrictions, regulatory crackdowns, property sector crisis, and geopolitical tension impacting its appeal to investors. The stock market is collection of exchanges where investors can buy and sell company shares. These things we have already seen. Securities and also include over-the-counter marketplace where investor can trade securities directly with each other. That is over-the-counter. Now, what kind of markets are there? So one is primary market. Primary market where the companies are directly selling their shares, right? Not being traded, but directly selling to the companies directly involved in selling the shares. So issuance of new securities by companies to raise capital. This includes process like IPO, initial public offering, and right issues. Initial public offering, IPOs, means first time company is selling its share in the stock market or share market. Secondary market, where the trading takes place. So trading of existing securities among investors without involvement of the issuing company through exchanges such as NSE, BSE, etc., provides liquidity to investors and allow price discovery based on market demand and supply. So suppose if I am selling my shareholdings in any different company, then that will represent what? That will represent, if I am I hope I'm audible. So if I'm selling my shares there, so you can understand that if I am holding some shares and I'm sharing with some I'm sharing it, I'm selling to some other investor, some other buyer, not involving company directly, that is secondary market, right? So primary and secondary market. Now let's talk about exchange traded currency derivatives, exchange traded funds, etc. I hope we can understand these are some issues related to stock market. So the Reserve Bank of India has postponed the implementation of its new norms for the exchange traded currency derivative market. Now, what is exchange traded currency? That exchange traded currency derivatives, that the rate can be taken from a particular financial market instrument. This decision follows concerns raised by market participants regarding participation in the ETCD market, which led to increased volatility in the forex market. So how we can link our exchange rate with certain derivative, that is the idea here. So the new norms aims to allow users to take position in the foreign exchange derivative market without needing to establish the existence of underlying underlying exposure up to single limit of $100 million equivalent across all currency pairs involving the rupee. However, the RBI emphasized the regulatory framework for ETCD remained consistent, guided by Foreign Exchange Management Act, that is FEMA 1999, in which the rupee is not fully convertible on capital account. Users are required to ensure compliance with the requirement of having underlying exposure, and the limit for taking positions was subsequently amended to single limit of $100 million combined across all exchanges. While the postponement may not have immediate implication, it could lead to increased trading volumes on such platforms, stabilizing pressure on this options premium, right? For example, when we are having such kind of trades, then options forward market and this forward market is there, future option, etc., swap, etc., are there. What are MDBs, right? When we talk about MDBs, this is multi lateral development banks, right? For example, World Bank Group, that we have already seen 5 organs of World Bank Group, etc. So my MDBs are international financial institutions. Example, World Bank Group and the Asian Development Bank, aiding developing countries with financial and technical assistance to foster economic development and reduce poverty, right? Recommendations by the independent expert group on MDBs reform, that is during India's G20 presidency when it happened, include a tripling annual lending levels by 2030. So whatever these multilateral banks are lending, that has to be tripled, right? That has to be multiplied by 3. Adopting a triple mandate for MDBs to eliminate extreme poverty and modernizing this funding models. For example, least developed countries, poor underdeveloping countries, underdeveloped countries, or for that matter developing countries, also need more loans at less interest rate so that they can expedite their developing process, right? Financial Service Institutions Bureau, FSIB. FSIB has recommended Manoj Mittal, currently the managing director of IFCI, has as the new chairman and managing director of the Small Industries Development Bank of India. These personality based updates are not much important, but you can understand here about Financial Service Institution Bureau. Additionally, Sanjay Shukla has been selected as the managing director of National Housing Bank. Again, not much important. FSIB constituted in yes, these informations are important for us. 2022 Department of Financial Services under Ministry of Finance by central government, replacing Bank Board Bureau. So Bank Board Bureau has now been replaced by FSIB, that is Financial Service Institution Bureau. This is important, right? Now it plays or Bank Board Bureau or this FSIB, FSIB is for example, for higher positions, they are recommending people. So FSIB has recommended these people, right? The FSIB is an organization responsible for selecting directors for state-owned banks and financial institutions in India. State-owned banks, for example, public sector banks, right? State-owned banks, for example, public sector banks. And when we say financial institutions in India, like SIDBI, Small Industrial Development Bank, right? Small Industries Development Bank of India, that is SIDBI. SIDBI, NABARD, for example, these are all India financial institutions, right? It acts as headhunter, identify and recommend suitable candidates for leadership position within the financial sector, because it is prone, experts are needed there, the financial institution. And for that matter, we have already seen many kind of fraudulent activities, etc. That is why. Payment aggregator, when we pay online, for example, when you are shopping online, then maybe PayU, you must have seen PayU, you must have seen many other financial intermediaries, like Paytm also is one of the financial intermediaries. So Paytm payments aggregator like PayU, a digital financial service provider, has received in principle authorization from the RBI to operate as payment aggregator under the Payment Settlement Act 2007, payment aggregate. With this approval, PayU can onboard new merchants on its platform. A payment aggregator is a third-party service that allows customer to make payments and businesses to accept payments online. For example, if you are purchasing something from Amazon, Flipkart, etc., so when you are making payment, they are the financial intermediaries which help in making payments and accepting payments at business level. Payment aggregators allow business to accept a variety of payment methods, including maybe debit card, credit card, EMIs, UPI. For example, when you purchase something, you convert it on EMI, you purchase it on EMI base, this bank transfers, e-wallets and e-mandates. So these are payment aggregates. When you are submitting order, this is contact gateway, and when this confirm payment, so this is payment gateway when you are confirming payment, and this is payment processor which settle payments through bank, right? This is, I hope this diagram explains you best. So this is payment, this is merchant, this is customer, this is merchant. So they are having transaction. He is selling, merchant is selling its product, and customer is purchasing, and customer is making payment. So these are financial intermediaries. As you can understand, this is bank, right? So this is the online platform on which you are making payment. So this is payment aggregate, right? Now, asset reconstruction companies we have already seen. Asset reconstruction company means what? This is bank for that matter, right? This is bank, and these are the depositors which have made payment. So these are depositors. They have deposited their money in the bank. So this is bank, right? And what has happened? This bank has extended this money as loan, right? As loan to borrowers, right? So now borrowers have taken this loan. So this loan that the bank has given to these people, this is not bank's money, this is depositors' money, right? Now what has happened? Suppose entire deposit is 100 crores, right? Suppose entire deposit is 100 crores, and this bank has extended loan of 10 crores, right? Extended loan of 10 crores, and this 10 crores has not come back, has not come back, because these borrowers have defaulted. So now they are not paying their EMIs, or they are not paying their principal amount, interest, etc. So this money has not come back to the bank. Now what has happened? This, after 90 days, it has turned into NPA. 1 year, 2 year, 3 year, it has turned into a bad loan. Now bad loan. Now bank needs to provision entire 100% amount, that is this 10 crores bank will put in these deposits, these accounts, from their own money, maybe from their own profit, maybe from their assets that they are having. So what will happen now? That now entire 10 crore has to be provisioned by banks only. So we have provision of this asset reconstruction companies. What these asset reconstruction companies will be doing? They will be purchasing these loans. So they will purchase these loans. How they will purchase these loans? They will purchase the rights of recovery. So they will purchase these loans. That means they will purchase rights of recovery. They will purchase rights of recovery. What do we mean by purchasing rights of recovery? That now they will be paying upfront to the banks. For example, this 10 crores loan. So suppose they are paying 4 crores to the bank. So bank has got 4 crore. Now how much bank has to provision on their own? 6 crores. So 4 crores at least bank has got from ARCs. Now what ARCs will be doing? Why they are paying 4 crores? Because now they have got rights to recovery. So they can recover some amount, and they can recover maybe out of this 10 crores loan, they may recover 6 crores, 7 crores, right? So 6 to 7 crores they can recover. 4 crore they have already paid to the government. So 2-3 crores profit they can earn. That's it. That is asset reconstruction company. I hope you can recall. We have discussed it also. Since it is little important, so we have discussed it again. RBI has issued master direction for asset reconstruction companies effective from April 4, 2024. This have been issued in exercise of the power conferred by SARFAESI Act 2002. SARFAESI Act also allows this banks or lenders to sell their collaterals. Whatever collateral they have received, they can sell those collaterals, right? The guidelines stipulate that ARCs must maintain a minimum capital requirement of 300 crore, with existing ARCs given until March 31, 2026 to meet this threshold. So they should have their own capital. That is known as what? Capital requirement. So maintain capital requirement of rupees 300 crore. Non-compliant ARCs will face supervisory action, including the prohibition of incremental business until compliance is achieved. ARCs with a minimum net owned fund of 1000 crore can act as a resolution applicant and are permitted to invest in specified instruments subject to certain conditions and caps on investment. An asset reconstruction company is a financial institution, we have already seen, that buys non-performing asset or bad assets from the banks or financial institutions so that later can clean up, or later, that is, the banks can clean up their balance sheet also, right? This is about the ARCs. Now RBI's digital payment index rises in September 2023. So for example, with the rise in volume of digital payments that we are doing with respect to UPI and all, so that is how we are rising in that particular index. So RBI's digital payment index, a measure of extent of digitalization of payment across the country, increased to 418.77 in September 2023 from 395 in March 2023. The RBI DPI, that is digital payment index, has increased across all parameters and was driven particularly by growth in payments enablers and payment performance and customer centricity across the country over the period, the central bank has said in its release. RBI Digital Payment Index, if we talk about, it has been constructed with March 2018 as the base period, that is DPI scores for March 2018 is set as 100. That is how we calculate, right? Consumer price index, etc. We have seen what is base period, how we calculate base. So we make 100 as the value for the base year, and then we compare from that. In September 2019, the index stood at 173, which rose to 217. All these things are not important much, but you can understand that in digital payment index we are rising, right? That is digital payment index. Parameters of RBI, the comprises of 5 broad parameters that measures the penetration of digital payments in the country over different time periods. These parameters are: number 1, payment enablers. The weightage is 25%. Then payment infrastructure, demand side factors 10%. So weightage is different. That can be the question in the exam also, that the weightage are different or which 5 parameters are there. Payment infrastructure, supply side factor 15%. Payment performance, that is 45%. Consumer centricity 5%. Publication frequency and the publication frequency with respect to index, and the central bank publishes the RBI DPI on a semi-annual basis with a lag of 4 months. So 4 months lag will be there in the data when it is being published in the September. So the data will be from the month of May or June. RBI suspend Paytm payment bank's core service. So Paytm payment bank, RBI has suspended. Now I'll tell Fino. There are many payment banks. Earlier Paytm was also a payment bank, but now it has suspended the license of payment bank. So now it is only a kind of wallet and payment intermediaries, as we can understand. RBI has barred payment Paytm bank from onboarding new customers and offering services like digital wallet and UPI transaction from March 1st, 2024. Effective cripples most operations of the Paytm bank. As per RBI directive, Paytm payment bank cannot offer services like accepting fresh deposits, issuing credit card, debit card, opening current and saving accounts, etc., and providing payment aggregator services. It also cannot enable transactions via UPI, IMPS, NEFT, RTGS, or issue FASTag and RuPay cards. So these banking services of Paytm has been stopped by RBI. The RBI can only allow, also the Paytm can only allow withdrawals from existing accounts and balances. All pipeline transactions initiated before March 1 should be settled by March 15. Why it has happened? With over 100 million KYC, that is know your customer verified user, and 8 million FASTag issued, a large customer base will be impacted here. However, customers can withdraw their account balance without restrictions. So no restrictions on withdrawing. Right now it has settled, since it is little old information that we are discussing, so that we can cover holistic current affairs updates. So though the exact reasons are unclear, but media sources suggest RBI had concerns regarding KYC compliance, IT systems, and data sharing with Chinese investor, because the Chinese 197 that is 197 communication, that is Chinese company which is having their investment in this Paytm. Paytm Payment Bank has earlier faced scrutiny since 2018 over process of user onboarding, KYC norms, maintaining arm's length from the promoter entity, and meeting the net worth criteria. In October 22, RBI had imposed 5.4 crore penalty on Paytm payment for non-compliance related to identifying beneficiary owners, monitoring suspicious transaction, and cyber security incident reporting delays. March 2022, RBI ordered stopping onboarding of new customers due to persistent non-compliance and material supervisory concerns. RBI has been wary of Chinese investor in Paytm since Ant Financial, an Alibaba affiliate, holds around 10% stake in 197 Communication, the parent firm of payment Paytm. Right, with India-China tensions, Chinese investment have faced increased scrutiny. Paytm was unable to address RBI's concern over data access by Chinese shareholders. So this is related to Paytm. Now, impact on India's fintech sector. As a poster boy of India's fintech revolution, this Paytm was one of the biggest beneficiaries of demonetization in 2016. It pioneered digital payment in India. However, the RBI action represents tightening regulation of the financial fintech sector or financial technology center. Other firms will also face increased scrutiny and need to ensure full compliance. The Paytm saga is a reminder that growth with weak foundations cannot be sustained. This will push the fintech firms to strengthen their risk management, compliance and corporate governance, right? This is what we can understand by having inferences. So everything need not be remembered as it is there in the video, as it is there in the document, but we can draw some inferences as well, that since it has happened now, there should be more emphasis on compliances, right? RBI places digital curb on Paytm payment bank. We have already seen this, right? Because compliances, central bank has prohibited this Paytm payment bank limited from accepting fresh deposits and transactions. This is what we have already seen. Paytm Bank is a new type of bank that can perform most banking operations but cannot issue credit cards, right? Credit cards, loans, etc. Payment banks are registered as public limited companies and licensed under the Banking Regulation Act of 1940. This is important. Payment banks can accept, as UPSC has already asked question, that on which committee has recommended this payment bank, and Nachiket More committee, etc. So that can be, these questions can have already been asked in the RBI directs credit card issuer to provide multi-network operations, right? Multi-network operation when the we transact through RBI, we transact through credit card. So multiple network options should be there in a significant move to promote customer choice and fair competition, so that monopoly cannot be created. RBI has issued directions to card issuers instructing them to enter into any arrangement not to enter into any arrangement or agreement with card networks that restrain them from availing the services of other card networks. The directive aims to ensure that customers have the freedom to choose from multiple card networks as at the time of card issuance or renewable. For example, what is current scenario? The card issued to a customer is decided by the card issuer, right? The that is bank or non-bank, for example, and is linked to the arrangements that the card issuer have card network in terms of their bilateral agreements. However, the RBI has observed that some existing arrangements between the card networks and card issuers are not conducive to the availability of choice of the customer, promoting the central bank to take action, right? Card network and card issuer are having their arrangements, and these arrangements are not giving choices to the customers. Directive for card issuer is, under new directions, card issuer are prohibited to entering into any arrangements or agreements with the card networks that restrain them from availing the services of other card networks, right? So that is to enhance the options for the customers. Authorized card networks are, the RBI has identified several authorized card networks including American Express Banking Corporation, Diners Club International Limited, MasterCard Asia Pacific Limited, and this National Payment Corporation of India, NPCI, which is issuing RuPay card, and Visa Worldwide Limited, and these networks will be available for customers to choose from when obtaining new cards or renewing or existing ones. So these networks will always be available. Exemptions and exclusions, for example, the direction will not on allowing users to pick the network shall not be applicable to credit card issues with a number of active card issued by them being 10 lakh or less, right? So if this is the case, additionally, card issuers who issue credit cards on their own authorized card networks are excluded. So if they are having their own network, then this is not an issue. Now, if we talk about impact on industry or benefits for customer, maybe customer choices are there. Impact on the industry may be expected to have a significant impact on the card issuing industry, promoting fair competition, etc. That is to limit the kind of monopoly that can happen from this. RBI pushes for rupee payments in oil imports, right? For example, this oil is one of the significant commodity that we are having, and we are dependent on imports only, right? Because we are not having vast oil reserves and all. So we are having what we are having, we are bound to import these crude oil, for example. And see, oil sector is having other significance also. For example, we import a lot of crude oil, but we are having a lot of refineries already set up, and we export also the petroleum products that we extract from the crude oil. So what we can understand from this is we are one of the largest importer. We import a lot of crude oil, but we are generating some foreign exchange also from this exporting the petroleum products as well, right? But when we are making payment in rupee, that will help in releasing pressure on balance of payment, or for that matter foreign exchange, right? Forex reserve. Why it helps us in releasing pressure? Because now if we are making payment in rupee, for example, we are having some nostro vostro arrangement as well. With respect to those nostro vostro arrangements, we make payments in Indian rupees as well. That is also possible, right? So RBI pushes for this so that less pressure will be there on foreign exchange reserve. That is the whole idea behind this. Now we can see some arrangements here, that the Reserve Bank of India has instructed India's major state-owned refineries to press Persian Gulf oil suppliers to accept at least 10% of oil payments in rupee in the upcoming financial year. This move is aimed to promoting the Indian currency in the international trade. Internationalization of rupee is also one of the topic that we will be discussing at some point of time. That is also important with respect to exam. And internationalization of rupee, one hurdle is capital account convertibility. So when we will discuss that, we will study that. International trade and reducing the country's dependence on the US dollar. India's growing energy demand and currency concerns. India is the world's third largest crude importer and expected to be leading driver of global oil consumption growth this decade. So the government is concerned that India's booming demand for energy will put downward pressure on the rupee. That as of now also you can see that rupee is sliding a lot. By leveraging the growth in consumption, the RBI seeks to promote the use of Indian currency in international trade. Now, owned refiners. State-owned refiners means public sector enterprises, right? Oil exporters. Three major state-owned refineries, Indian Oil Corporation, Bharat Petroleum Corporation, and Hindustan Petroleum Corporation, have already approached oil exporters regarding the rupee payment proposal. However, the suppliers are pushing back due to concerns over currency risk and conversion charges, right? When this rupee, because foreign countries has nothing to do with Indian rupee, right? So that is why conversion charges are there. Sometimes rupee is highly volatile. It is sliding a lot these days, you can see. So the oil exporter resistance to accepting rupee payment is rupee payment stems from the potential currency risk and the associated conversion charges. To address this issue, the RBI has asked the Indian refineries to bear a portion of currency transaction charges. However, refiners are also resisting this idea as it would erode their profit margin. So when they have to bear charges, they will their profit margin will reduce. Dominance of US dollar in global oil transaction. This we already understand. The vast majority of global oil transactions are conducted in US dollar. China has had some success in using a yuan to pay for its oil imports, but the dollar remains the dominant currency. This is one thing. Previous instances of non-dollar payments. In August last year, Indian Oil partly paid Abu Dhabi National Oil Corporation for a shipment of 1 million barrels of crude oil in rupees. However, there haven't been any transaction in the Indian currency since then. So India's refiners have to use other currencies using UAE dirhams to pay for Russian crude oil, right? Challenges in implementing rupee payments. The implementation, as you have already seen, currency risk, concerned about the potential fluctuations, downsliding of rupee. Conversion charges, we have already seen the conversion of rupee to other currency may incur additional charges, right? And resistance from refiners also. Indian state-owned refiners are hesitant to bear the currency transaction charges as it would impact their own profit margin. So this is what we can understand. Now, limited precedence is there. While there have been instances of non-dollar payment of oil imports, such as the use of rupee and UAE dirhams, these occurrences have been limited and sporadic. That we have already seen. At one point of time, we have done payment in rupee. Potential benefit is, despite the challenges, RBI push for rupee payment in oil imports could yield several benefits. One is rupee reduced dependence on US dollar. So the holding cost of the dollar will also come down, and maybe our this foreign exchange reserve will not have much pressure. So by promoting the use of rupee in international trade, India can reduce its reliance on the US dollar and minimize impact of dollar fluctuation also on its economy. We will not be much dependent. Strengthening the Indian currency, when many currencies will transact in Indian rupee, then we may have strengthening the rupee. Increased use of the rupee in global trade could help strengthening the currency and enhances its international standing. Leveraging India's growing energy demand. As India's energy consumption continues to grow, the country can use the market power to negotiate favorable terms, including the use of its own currency for the payment. But it's time to see whether this happens or not. But if we are having frequent downsliding of the rupee, it may impact such decisions or such policies. RBI direction for electronic trading platforms, ETPs. The RBI released a draft master direction for electronic trading platforms seeking feedback from stakeholder by May 31. Now, what is electronic trading platforms? These are the platforms where the trading happens. So, electronic system that facilitate trading of various financial instruments such as securities, money market instrument, foreign exchange instruments, derivatives, and more. Unlike recognized stock market, ETPs operate as electronic platform where buyers and sellers can execute this trades electronically, right, on online platforms, etc. In India, example of this includes NSE now, BSE Bolt, currency ETPs, etc. These are the things, right? RBI's direction is the RBI issued a draft master direction on these electronic trading platforms in 2024, stipulating those entities must obtain prior authorization and registration from the RBI, right? Because the investor interest has to be taken care of, and to prevent this from any fraud activities, etc. Now, what kind of initiatives that have been launched by the RBI? So RBI launched three major initiatives. One is GSEC mobile app. GSEC is government securities, right, also known as treasury bills. So government securities will be purchased by retail users also, and for that we have one GSEC mobile app. Enables retail investor for people like us, households, right, enables retail investor to transact in government securities using smartphones. Prava portal, a centralized web-based portal, individuals or entities to apply for authorization, license of regulatory approvals from the RBI, enhancing efficiency in processing applications. And fintech repository, a data storehouse for Indian fintech firms to help understand the sector better and design appropriate policies. Additionally, MTech repository for the RBI regulated entities will track the adoption of emerging technologies like AI, blockchain, etc. in this entire payment settlement system, digital payment system, etc. These initiatives aim to improve this accessibility, efficiency, and data management in financial and regulatory process. I hope we can understand it. Now, RBI stricter regulation for project finance. So some strict regulation are also there from the RBI. So propose stricter regulation to project finance, aiming to reduce risk in infrastructure projects, right? Because sometimes what happens with respect to delay in projects, for example, 5 year earlier estimated, right, at the time of loan, etc. 5 years have been estimated, and what happens later, that because of many project delays, etc., the project will be delayed and it gets completed in 10 years. So the project cost increases, wage rate increases, and the cost of raw materials, etc., everything increases, and that incur huge cost on the project. And sometimes the loans that have been given to complete those projects become NPA, right? These rules include higher provisioning during construction, and classifying delayed projects as non-performing asset. According to RBI guidelines, lender must maintain 5% provisions for projects under implementation. Provisioning involves bank setting aside funds from there. We have already seen what is provisioning. If the loan that has been extended by the bank is not coming back, then bank should set aside some fund from their own profit or from their asset. Lender fear these rules could hinder projects viability and also and slow India's capital expenditure momentum, right? If these kind of rules are made applicable, then what will happen? Banks will have less confidence in giving loans, or bank will not feel it feasible, because they have to provision certain amount, and infrastructure projects, there are huge amounts involved in it. RBI scrutinizes gold and loan norms to tighten grip. So for gold loan norms, for example, Muthoot Finance, etc., NBFCs are also involved in giving gold loans. The Reserve Bank of India made harder for non-banking financial companies, that is NBFC. Muthoot Finance is also one of the NBFCs to do business by telling them in March that they had to follow rules for gold loans carefully. As a result of breaking these rules, IIFL Finance was not allowed to give any more gold loans, right? So what is the reason for reinforcement of gold loan norms? Why it is there in the news? So RBI made its choice after discovering that some NBFCs had broken the rules by overhauling collateral and not following loan to value ratio. For example, when you are taking gold loan, so you are mortgaging some gold, right? Whatever you are having, so you are mortgaging that loan. Whatever loan you are having, so that is RBI has already prescribed that what kind of loan value you can give for the value of mortgage, right? And some NBFCs, because loans are asset for the NBFCs as well, when they extend loan, so they earn interest on that, which is their profit. So they are likely to give more loans, so they are not adhering to the policy that has already been given to them, that for this much gold you can give this much loan value, right? These violations show that NBFCs are putting too much emphasis on growth over caution, which could lead to widespread problems as the sector grows, because RBI is having, sorry, NBFCs are having rollover risk. Rollover risk means what? They are not accepting deposits. Very few are accepting deposits. Otherwise, many NBFCs are raising fund from the stock market, the bond market, the share market, means basically from this from bond market. They are issuing bond and they are raising fund. When they are issuing bond and they are raising fund, they have to pay back money, right? When the bond gets matured, so they are taking their bonds are being purchased by banks, and if NBFCs are defaulting on their loans, banks also may face low liquidity. The loan of bank will turn NPA, and again bank have to provision that amount. So the loan amount can't be more than 75% of the gold value. This ensures that lender have extra money in case of borrowers doesn't repay the loan. No, not more than 20,000 can be given out in cash. Any more money must be sent through a bank transfer only, and gold that has been reprocessed must be auctioned for clearly, so that borrowers can see the lots. Implication of increased RBI NBFCs, what will happen? Maybe it can lead to contractionary monetary policy. So by making it hard to get cash right away, the tighter control should make NBFC gold loan less appealing, right? So people will also not go into this, and slow down the rapid growth of loan books by making sure that loan to value limits are strictly followed, and raise the cost of doing business also for NBFC, because gold bids need to be more open and clearly marked. Now, more about RBI gold loan norms. If you can see, under the gold loan, the Reserve Bank of India says that commercial banks can give up to 90% of the value, because it is commercial bank. This is up to from 75% before. The higher loan value will last until March 31st, 22, and is meant to ease the stress on the economy caused by COVID-19, right? Now, these loans have lower interest rates than personal loans, because they are backed by something. So at least you have given some collateral, so you will be having less interest rate here. In order to get a loan, the loan must be between 18 to 24 carats pure gold. Loans can be paid back over a period of few months to a few years based on the lender's rules. Non-banking financial companies, that is NBFCs, also offer gold loans, but their interest rates and LTVs are not the same bank. So we have already seen what is the loan to value ratio, right? How much loan value you are taking and how much is the value of mortgage. So this is where we will stop here, and we will meet in the next class. So stay tuned to Victory IAS YouTube channel for more updates which will help in your prelims 2026 exam. Thank you very much. Take care. Bye bye.